Stop predicting where the market's going to go. Build a narrative instead. So, what actually is a narrative? And at face value, yeah, you could say it's just bullish or bearish, but it's more than that. A narrative is basically the story that the market's telling you about where price actually wants to go and why. It's not just, oh, we're bullish. It's connecting all the pieces, liquidity, order flow, market structure, your higher time frame levels, timing, all of it into one idea. Instead of just looking at these things individually and going, oh, there's fair value gap, cool. No, you got to connect it. So for example, instead of thinking, oh, there's a fair value gap, or there's equal highs, or oh, there's an IFEG, like, okay, cool, that works, it's not wrong, but it has one key issue. And that issue is the market almost always has stuff that defends both sides, bullish and bearish. So if you just trading off, oh, I see a value gap in isolation, you're missing why it actually matters. So look at this example right here. We're ranging between relative equal highs, stacked low resistance liquidity, and below that, we got an unfilled 4-hour fair value gap. Now in this case, honestly, it's pretty easy, in my opinion, to already assume where price is trying to go. And I would actually call this an unfair range, because unfilled higher time frame gaps, honestly, are a bit stronger. They're stronger than highs and lows, even equal highs, even with liquidity stacked leading up to it. So why is that? Why does an unfilled high time frame gap outweigh equal highs with liquidity resting above it? Because the market moves internal to external. That's the whole concept. The market likes to hit internal liquidity first. That's your higher time frame gaps, your NWOGs, your high time frame rebalances, your order blocks. It hits that first. And then from there, it targets external liquidity. So when you've got an unfilled internal level sitting there untouched, the market's not done. It needs to tap that level. And from there, once it gets there, you can expect it to run external liquidity after that. So this is also called a market maker model. And basically, what you've got here is a buy model and a sell model. And the way that these work, you got to ask yourself, are we on buy side of the curve or are we on sell side of the curve? So for a buy model, as price continues lower, you're actually generating liquidity that's going to get taken out later. That's called engineering liquidity. Once the key level is hit, down here, that could be a 4-hour gap, 1-hour gap, new week opening gap. And then that internal level is hit. We expect the shift to the buy side of the curve as we engineer this liquidity down here. And now as we move out of our higher time frame gap, we expect to fill that liquidity that we generated for ourselves, creating the curve. And basically for a sell model, it's the exact same. It's basically just we're generating up this time instead, creating engineered liquidity, hit our key level, and from there we distribute down, filling all of that liquidity that we just created and taking out that external draw. Again, kind of works like internal to external. You hit the internal level on a buy model or the internal level on a sell model, and now we're targeting external liquidity being these lows in this scenario in the sell model, and then in buy model it'll be highs. And then there'll be that overall external draw, which could be a major buy side liquidity or major sell side liquidity being like maybe a daily low, 4-hour low, something like that. Now we want to know this on the high time frame and the low time frame. Are we in a buy model or are we in a sell model? And that correlates directly with internal or external liquidity. The questions from earlier, stuff like, has external liquidity already been achieved? Are we repricing before we continue? That kind of thing. That's what gives you the idea of where we should actually be trending right now. If we're in a buy model, we're looking for longs. If we're in a sell model, we're looking for shorts. Now there's one more level to this, and this one's important because it lets you quickly change your bias, and honestly, it makes reading the market a lot easier. So this is called conditions. So in this example, we tapped a 15-minute fair value gap. Now let's say we're in a buy model. If we want the buy model to continue, we'd expect this 15-minute fair value gap to inverse and price to continue higher. But there's one thing. Why would you predict that it inverses instead of just wait? If we wait and instead it decides to reject off of this area, we can transition our bias to bearish. Even if we're technically still in a buy model, either the buy model is failing or we're shifting into a sell model, or we just need some kind of retrace. Either way, we can use this 15-minute gap. Honestly, any gap could be a 5-minute that just opened up or a 30-minute, whatever time frame. During these moments, honestly, I just sit back, I'm on my phone, I'm waiting to see how the price reacts off of these gaps. Be reactive, not predictive. Because honestly, with this 15-minute gap or 30-minute gap or 5-minute gap, it basically can tell you the whole story for the next like 15 minutes to 30 minutes. And basically that's one move for you. So that could just be one trade. Because if we inverse, obviously, now you can expect another continuation long in any scenario. If we then reject instead from this 15, you can maybe catch a reversal short or wait even longer. Then a new 5 minute opens and then taps the 5 and then rejects. From there, you have another clear target. So right now, we're ranging in this 4 hour time frame. This is like the current conditions of July 2026, and it doesn't look great. So you want to see expansion usually, or you're retracing into an area filling some imbalances. But right now, we're not hitting any key levels. We're just ranging between bullish and bearish key levels. So how do you trade this is like what I'm going to tell you right now. You can still trade inside these conditions like this. It just requires way more patience and way more reactability. If you're a beginner, honestly, I'd sit out when the higher time frame looks like this. But if you actually understand how the market moves, this exactly when you use the lower time frame conditions I just talked about. So when we're in a range, we've got range high and a range low. So it kind of look like this. You have the range high and you have the range low. Now, there's a lot of consolidation inside of here, but that's the basics of it. So inside of this, that's called premium and discount. Above the midpoint is premium. Below the midpoint is discount. So why is that important? So when we're in discount, if we're bullish, those discount fair value gaps, they should hold. And using conditions, if they don't hold, we can flip to bearish. Same thing with premium. If we're bullish and we're in the premium area, we'd expect the bearish fair value gaps not to hold. We should inverse right through them. But if we fail to inverse through them, we can expect lower. That's literally how you use conditions. So key takeaways from all of this, there's 3 things. Internal to external. Remember, the market hits internal liquidity first before it goes and runs external highs and lows. Next is the market maker model, market maker buy and sell model, knowing whether we're on buy side or sell side of the curve. So then you can know if we should be prioritizing longs or shorts. And lastly is conditions. We want to be reactive, not predictive, and using conditions, we can wait patiently to see how they react of key levels that hit, such as 5 minutes and 15 minutes, 30 minutes, other key levels like that, to basically confirm or flip our bias. Put those 3 together, and that's really how you build a narrative. If you have any questions about any of this, comment down below and follow for more.